Okay, guys, so this is the last lesson before the midterm exam. So we have to work hard today because we have many contents we have to discuss with. So let's come back to the roadmap. The roadmap is the roadmap for the investment process, for the managerial process of private equity investor. And we said yesterday that if we want to analyze the managerial process of whatever kind of private equity vehicle in the world, it's fundamental to identify 4 different phases. The phase number 1 is the fundraising. The phase number 2 is the investing or the investing process. The phase number 3 is managing and monitoring, and the phase number 4 is exiting. So we have 4 different phases: fundraising, investing, managing and monitoring, and exiting. As I mentioned yesterday, please take care, because the lesson of yesterday and the lesson for today is not very difficult, but it's fundamental because we have really to set up the usage of language for practitioners in private equity. So when I mention fundraising, investing, managing and monitoring, and exiting, it's perfect to stay in a classroom, but it's also perfect if you want to speak the language of practitioners. So typically practitioners identify these 4 different phases. Yesterday we discussed about fundraising. You remember we identified 5 different micro phases which characterize fundraising. Please take care, because fundraising is the same in whatever part of the world, but you have to take care of some differences considering the fact that the vehicle can leverage or not the amount of money you can invest. Today we have to discuss about the 2 most important topics, which are investing and managing and monitoring. Let's start from investing. Investing, yesterday we said, okay, investing is the investing of the money you have in your portfolio. But if we want to discuss about investing, we have to identify, I can say, 2 different activities, really 2 different categories of activities we have to manage. The first category of activities is the problem category of valuation activities. So we have to discuss about valuation. The second group of activities is the so-called techniques to finance the company, to finance the deal. So, technique to finance the deal. So 2 different stories. First of all, you have a problem to evaluate the targets, to evaluate the companies that could represent a target for you. And second, your second problem is to identify or to create or to package the different financing which are fundamental to give money to the company. So really 2 completely different stories. So take care, because when we say techniques to finance the deal, in the language of practitioners, we do prefer to say the contractual package. This is the package. That means the group of rules, of contracts, of techniques you have to use to give money to the company. So really, not sometimes. Many times we do prefer to say this is the package, the contractual package you have to create for the investing. But however, let's start from valuation. Valuation means to evaluate a company, but take care, because when we say valuation, in private equity, valuation is a process. And in this process we find 6 different activities, which is fundamental to highlight. So I'm sorry, because when there are a lot of activities, a lot of bullet points, I know it's very hard for you, but okay, this is life. This is private equity life. What are the activities of valuation? The first activity is the so-called origination or deal flow. This is the activity number 1. I do prefer to give to you the labels first of all. Origination or deal flow. Origination is more academic. Deal flow is better for practitioners and for newspaper. But however, you can use both, origination or deal flow. The activity number 2 is screening. Activity number 3 is due diligence. Activity number 4 is rating. Assignment. Activity number 5 is negotiation. And activity number 6 is decision to invest or not. Decision. So 6 different activities. The labels are self-explaining, so it's not difficult. What is important for me is that you remember the process and you remember the rationale behind we have to discuss. So let's start. Origination or deal flow. Origination means to discover potential target, to discover potential targets. This activity is an activity which is tremendously time-consuming because to manage origination, you have to travel around the country, you have to stay in the network, you have to use your personal contacts and relationships, so it's tremendously time-consuming, especially is in the origination that the managers strongly need the support coming from the technical committee and the advisory company. The reason why you have a technical committee and an advisory company is for many purposes, for reputation, but first of all, you need an advisory company and a technical committee because of the origination and the deal flow, okay? If you have a very strong technical committee, your expectation is that a great deal flow, because they stay in the network, they have a very big reputation, and they can generate a lot of targets and a lot of contacts, okay? So origination or deal flow. The second activity is, in my opinion, the most critical, is a screening. Origination, let's imagine, is cherry picking. Okay, you identify different targets in the market, potential business. The second problem is you have to manage a screening process. Screening process means if you have 100 or 200, 300 potential targets, you cannot evaluate all these targets. For what reason? Because it's too expensive, you understand? You cannot identify 3,000 targets and you run a due diligence evaluation for 300 companies. You don't have time and you don't have money to do that. Or to have money, you have to increase the management fee to 10%, okay? You don't have this possibility. So screening is crucial. Screening means the technical committee has to screen the potential target and to identify the target which could be relevant for a due diligence, for an investing process. Generally, the golden rate in the screening process is 10%. You identify 100 potential targets, you screen, and you say 90% are not relevant for the vehicle, 10% are relevant to go on. So this is a sort of golden rule in the screening process. Okay? The job of screening process is a job which is typically in charge of the technical committee. Because managers don't have time to screen potential investment. They don't have time, and they need the assistance of the technical committee. They have to screen potential targets. Okay, guys? Is it okay? You understand that it's critical. It's critical screening because screening has an impact on costs and screening has an impact on the future success of the vehicle. It's really, really crucial. It's obvious that if we stay in seed and startup, screening is dramatic and probably it's the key driver of your success. In expansion, replacement, screening is important, but is not dramatic. In seed and startup, screening is really the most important activity because you have to say, this project, no, it's rubbish. This project is okay. You understand that in seed and startup, it's really a critical decision. For the outputs of the screening process, that means, okay, on some companies, on some project, it makes sense to go on, you have to run the activity number 3, and for the activity number 3, you have to spend money because the activity number 3 is due diligence. That means, okay, we have 10 targets which are relevant, we have to run the due diligence. And to run the due diligence, it's a problem of money because you have to pay the advisory company to run the due diligence. Due diligence on a business plan, due diligence on the balance sheets, due diligence on the governance, the due diligence on the company. That could be a target for you. You see that if the screening process is not working properly, the drama is that you have to run the due diligence for a lot of companies. And if you run the due diligence for a lot of companies, you waste a lot of time and you spend a lot of money. And this is not convenient for you. So screening is fundamental because the output of the screening must be analyzed through a due diligence process. And due diligence process is expensive. Okay, guys? Generally, when you run the due diligence process, generally, is not written in the law, but generally you have also to start a rating assignment process. It depends from the market, it depends from the country, but in some countries, I don't want to say that to have a rating is mandatory for an investment, but is strongly recommended. If you stay in US and UK, when a private equity investor invests, it's not enough to run a due diligence. It's strongly recommended also to have a rating from a rating agency. And in the same time you run the due diligence, you have to start the rating assignment process. Obviously, also the rating assignment process is expensive because you have to pay the rating agency to run the rating assignment process. In the European Union, in countries like Italy, France, Germany, it depends from, okay, conventional wisdom and from the uses and the rules in the market, but in European Union is not recommended rating assignments. So if we say Italy, France and Germany, you don't need to have a rating. In US and UK, it's strongly recommended to have a rating too, but you have to pay the rating agency. Okay? Do you know what is the fee to have a rating from a rating agency? You know what is the fee, the average fee? You don't know? The average fee for small and medium enterprises ranges between 100,000 and 150,000 euros. This is the amount of the fee you have to pay to a rating agency to have a rating. So it's not cheap, it's quite expensive. So if you run the due diligence, you have to pay the advisory company, but in the same time you have to pay also the rating agency. Please remember that the money you have comes from the management fee, so take care, okay? You don't have a lot of profit when you manage vehicles. Please remember that for you the only revenues is the management fee, and with the management fee you have to pay, remember, technical committee, advisory company, rating agency, if it is mandatory. So take care about the size of the management fee and take care about the screening process, because otherwise you don't have money to pay these players. Okay? Negotiation. What is negotiation? Negotiation is negotiation. Negotiation means, okay, we run the due diligence, we have the rating, the result, the output of the due diligence are okay, so it makes sense to negotiate with the companies your intervention and your investments. Negotiation is about a lot of topics. Negotiation mostly is negotiation about the price, but negotiation is negotiation about the governance, negotiation about your future exit, so negotiation about your stay in the company. But mostly negotiation is negotiation on the price of the shares, okay? Negotiation is a cruel activity because there is a tremendous divergence of opinion, because the private equity would like to pay the lowest possible, not because the private equity doesn't have money, but because you want to have a very high internal rate of return. So your goal is to try to negotiate a very lower price. On the contrary, the companies would like to have a very high price. So the problem is to negotiate. Negotiation is a dramatic activity. And after the negotiation, you have the decision, and the decision means we push the button, yes or not. If we push the button, we decide to invest in the company. Take care that sometimes, many times, the decision is we don't invest. And it's a tragedy if the decision is we don't invest because we spent a lot of time for the origination, we spent a lot of time for screening, we pay the advisory company for the due diligence, we pay the rating agency, we spend a lot of energies in negotiating, and the decision is we don't invest. Just to give you an idea, it's very difficult to measure this activity, but a sort of implicit rule is that the 50% of decisions are we don't invest. So it's quite common to say the company is quite good, the due diligence is positive, but we don't invest. Why we don't invest? Because we don't find an agreement considering the price, we don't find an agreement considering the exit strategy, but especially we don't find an agreement in terms of matching between the amount of money and the amount of shares. You remember the exercise we discussed in the lesson number 3, the example on the Excel file, okay, when we calculated the financial need, you remember? And we discussed about the low-cost airline company. This was a good example. The amount of money, it's okay. The financial need, it's okay. But the problem is to match this amount of money with the amount of shares. And in many cases, it is not possible to find a match. You remember we said, let's imagine the amount of money represents the 90% of shares of the 5% of shares. In these two cases, it's very difficult for you to go on. And in these cases, your decision is, I'm sorry, I cannot invest. But if we say we cannot, we destroyed a lot of money. And remember that if you are a private equity vehicle, you have a cap every year for your revenues. And the cap is the management fee. Please remember, you don't have an amount of money which is free. You have a fixed amount of money per year, which is the management fee. So take care about the usage of money, because if you don't have money yet, you cannot run other due diligence, other rating assignments. So please take care about that. Okay? That's the reason why sometimes the idea of private equity vehicles is that private equity investors are very cruel in negotiating and in selecting targets. For what reason? For this reason. They have a cap in terms of revenues, and they have to select quite properly, with a very strong efficiency, the targets and the potential business, because otherwise we waste money. Okay? It's obvious that this constraint is strongly related to the ownership of the vehicle, because if the ownership is a bank, remember yesterday, or a corporation, I don't want to say you can waste money, but you have a strong bank, a strong corporation behind. So if you have a problem of shortage of money, mom or daddy coming from the bank and say, don't worry, Stefano, I pay for you the advisory, okay? But if you don't have anybody behind you because you are an independent or a professional, take care, because if you don't have other money, you cannot manage other due diligence or rating assignment. So take care about it. It's a problem of constraint and shortage of money. This is the story of valuation. If the decision is yes, you jump into another story, and the other story is, okay, we decided to invest in a company, now we have another problem, another story, and the other story is the techniques to finance the deal. Okay? Now we have to create the package to finance the company we decided to invest in. What does it mean to discuss about the techniques to finance the deal? If we want to discuss about the techniques to finance the deal, we have to highlight 3 different activities. So we have to highlight 3 different activities. The 3 activities are targeting, liability profile, and rules of engagement. I repeat, if you decided to invest in a company because the output of the decision is yes, we invest, we have a problem of techniques to finance the company. What does it mean to identify and to combine techniques to finance the company? It means 3 different activities. First of all, we have to identify the target in which we invest. Just to specify, we will discuss a lot about it. Target means we invest in a company or we invest in a NewCo we use to invest in a company. You have to identify the targets. Second, you have to design the liability profile of the company in which you invest. The amount of money you give to the company, it's okay, it's enough. Please remember lesson number 3, because we satisfy the whole amount of the financial need, or you have to help the company to raise other money through debt. So you have a problem of liability profile. And number 3, you have a problem to write, to fix rules of engagement. That means, okay, you stay in the company, but what kind of rules we follow, what kind of rules we apply? Because I'm very happy to stay in your company, but we have to write some rules, because otherwise I simply sit in your board of directors and I have no power, you understand? So we have to write rules concerning my engagement, not simply because I want to protect myself, but because coming from the company there is an expectation of help, an expectation of support coming from the private equity investor. So we have to discuss about these 3 topics. Let's start from the targeting. What is the problem of targeting? Is the first problem of techniques to finance the deal. The first problem we have is, okay, we decided to invest in a company, but we have to identify the target in which we invest. What does it mean? Targeting means 2 stories, and the 2 stories means vehicle in which we invest, and second, amount of share. So we have these 2 problems. We have to identify the vehicle in which we invest, and we have to fix the amount of share. This is the 2 problems of targeting. Let's start from the problem number 1. We have to identify the vehicle in which we invest. In the real world, we have 2 different options. The first option is direct investment. We invest in the targets. The second option, we invest through a NewCo, through a special purpose vehicle. So direct investment and through an SPV or a NewCo. Okay? If we invest directly in the company, we have to use an amount of money coming from our portfolio. If the investment is direct and we decided to invest 100 million euros in the company, we have to use this amount of money coming from our portfolio. Okay? That's okay, but in the real world, we can have a lot of constraints. What kind of constraints, Guy? If we decided to invest 100 million euros in a company of your colleague, okay? It's great, but in the real life, I could have some constraints. What kind of constraints? That's the reason why we use an investment through SPV. What kind of constraint we can have? The first constraint is that in my internal code of activity or in my LPA is written that the maximum investment in a company is 20 million euros. So if I invest 100 million euros in the company of Cindy, right, I cannot, because there is a constraint in the internal code of activity, so I cannot do that. And I have two solutions. The solution number one is to say, Cindy, I'm sorry, I cannot invest in your company. That is a pity, because we spend a lot of money in the valuation process. The second solution is, Cindy, I'm very sorry, I don't manage a direct investment, I have to use an SPV to raise money from the financing system. Other reason why we don't invest directly: we don't have money yet in our portfolio. I don't have 100 million euros in my portfolio today. For what reason? Because I invested a lot, and I don't have other possibility to exit from the other investment. So what I have to do to say no to Cindy, simply because I don't have money? The solution is, Cindy, I'm sorry, I use an SPV. I don't manage a direct investment. Okay? So that's the reason why in many cases, we don't run a direct investment, but we use the SPV. Obviously, if you use the SPV, we have a big advantage if we are the private equity vehicle, and the big advantage is that we can leverage the investment. That means we can multiply the performance and obviously the risk of the investment. Okay? Obviously, we use the SPV only if the target, which means the company of Cindy, has a very lower leverage, because if the potential target has a very high leverage, I cannot insert other debts. But in case the company has a very small leverage, it's possible to use the SPV. Okay, guys? Take care. It's a minor remarks, minor because we stay in the classroom. It's not a minor activity when we stay in the business. Obviously, when we identify the vehicle, direct or the SPV, in the same time, we ask to the company to sell all the assets which are not relevant for the business. Because I invest in a company, but I don't want to pay assets which are not relevant for the business. This activity is called asset stripping. Okay? I strongly recommend to the company to sell all the assets which are not relevant for the business, because otherwise I have to use more money. Okay? Is it okay? Yes or not, guys? Let's imagine in the company of Cindy, okay, use Cindy today as an example. Let's imagine Cindy is a food producer, okay? But in the balance sheet of Cindy, you find a lot of buildings, historical buildings, villas, okay? It happens a lot of time, which are not relevant for the business. Do you agree? Okay. If these buildings remain in the balance sheet, I have to pay this building. Do you agree? So before my entrance in the company, I say, Cindy, I'm very happy because you have a lot of buildings, you are very lucky, but please, you have to manage asset stripping. You have to sell these assets, you have to insert these assets in another vehicles, because I want to invest in a company which is fully devoted to the business. I don't want to have assets which are not relevant for the business. This activity typically is managed together with the decision of the vehicle to invest. The other problem you have in the targeting activity is the choice of the amount of share. The choice of amount of share means you have to match together the amount of money with the amount of share you have. Typically, in private equity investments, as we mentioned in the lesson number 3, private equity investors want to avoid cases, situations in which they have a lot of shares, 90–95%, or they have a small amount of shares, because in these two cases, it's very difficult to give an incentive to the entrepreneur or to have the possibility to manage the company. If we stay in these two cases, you have to find a compromise, and the compromise typically is identified through the liability profile and through the rules of engagement. For me, it's okay to have the 5% of the company of Cindy, but I would like to have rules of engagement that protect me, because otherwise it's too risky to give money to the company and to have no protection, because with the 5%, with the 3% of shares, it's really impossible to stay in the board of directors and to have the possibility to lead the companies. So these are the two typical problems, the two typical topics we have to face, we have to discuss when we identify the target. That means the targeting activity. The second story is the story of the liability profile, where liability profile means the design of the liability of the company in which you invest. So liability profile means the design of the liability of the company in which you invest. In the liability profile, typically you have two activities, two problems, two topics to manage, and the two topics are syndication strategy and debt issuing. So the two topics, the two relevant topics you have in the liability profile, that means the design of the liability of the company in which you invest. Typically you have two topics to manage. Topic number one is a syndication strategy, and the topic number two is debt issuing. What is syndication strategy? When you invest in a company, direct investment or through an SPV, you have a very important problem, and the problem is you invest by yourself or you try to identify other private equity investors to share the business with them. Okay? If you run and you invest by yourself, it's a good idea because you don't have to share the profits with other players. But again, you can have the cap and you can have the action of some constraints that can condition your investment. Let's imagine I decided to invest 100 million euros in the company of Cindy. I have 100 million euros. I decided to invest directly, but if I invest 100 million euros, I don't have other money for other investments. Okay? So I don't have a problem of direct or SPV because I decided to invest 100 million euros, it's okay. I don't have a problem of constraint, but if I invest 100 million euros, I don't have other money. And if I give a look to the screening process and the due diligence, I give a look and I say that there are other potential targets, so it's a nonsense that I give 100 million euros to the company of Cindy. What I can do, the only solution is to run a syndication. That means to identify other players that became your companion in the investment in the company. Obviously, the syndication strategy is a double face strategy, because from one side, it's a very smart solution, because through the syndication you kill competition. Okay? You decide to interact with other players, you share the risk altogether, you reduce your profit, but you share the risk. So it's a smart solution to kill the competition. On the other side, you can have a lot of problems. Coming from what? In syndication, you can have a lot of problems. Coming from what? Smart solution because you share money, you share risk. You generate a network effect because today I give to you an opportunity to invest with me, and my expectation is that tomorrow you give to me another opportunity. So it's a quite strong network effect. That's great. But on the other side, what kind of problems we can have in syndication strategy? It's a continuous trade-off in finance. What is the problem in syndication strategy? the interest is the same, is internal rate of return, but
there can be some conflicts inside.
Is the problem of divergence of timing and divergence of opinion. So we have the same opinion. We want to invest in a company because we believe that the company is quite interesting, and you have a very strong expectation of internal rate of return. But the problem is the timing. Let's imagine if we organize a syndication of 4 private equity investors. Today we are very happy because the company of Cindy is a quite good company, great. But tomorrow morning, let's imagine you work with me. I'm a private equity investor, you are a private equity investor. Your name is, Oriana. And I say, Oriana, we are very happy, we invest in this company. You say, Stefano, yes, we are very happy. The day after I say, Oriana, what do you think? The company of Cindy is quite good. My opinion is that we can stay in that company for 2 years, and at the end we can launch an IPO. And you say, Stefano, to launch an IPO, my opinion is that is not a good idea. It's better to sell the shares to another investor. And I say, Oriana, for what reason? I really like to launch an IPO. And you say, Stefano, I don't want to launch an IPO. Or another example is, I want to stay in the company of Cindy for 2 years. For what reason? Because I stay in the extra time, and I have a constraint. So I have just 2 years. And you say, dear Stefano, I have a different opinion. Because I started my activity yesterday, I can stay in the company of Cindy for 5 years. So it's a tremendous problem of conflicts between private equity, where the conflicts is typically related to, first of all, a problem of timing, and second, to a problem of strategy. Strategy in managing the company and strategy in managing the exit from the investment. So syndication strategy, quite smart to kill the competition, a very strong solution to cooperate all together, but a lot of potential conflict. We have to solve ex ante. But sometimes ex ante is very difficult because we don't have time. Business is quite quick, and Stefano and Oriana don't have time to discuss for 3 months to identify contracts to solve potential conflicts. We have to decide in 1 week. And so our problem is to decide if invest or not in the company of Cindy, not to discuss about our divergence of timing and opinion. That's the problem of syndication strategy. The other problem of liability profile is a problem of debt issuing, where debt issuing is debt issuing both in the SPV, if we use the SPV, and in the company, if we invest directly in the company. So when we identified the target, the company or the SPV, in both cases, we can have a problem of debt issuing. Debt issuing means we have to help the company to issue debt. For what reason we have to help the company to issue debt? Where to issue debt means to arrange a bond issuing or to go to the banking system and to negotiate loans. So debt issuing is debt issuing, both in bonds and in loans. For what reason we can have a problem of debt issuing and we have to manage debt issuing? For what reasons? And why have to do that? Why have to issue debt for the company?
Well, that's, you need to have strong motivations. You want to see a business plan, something that is real, and that they can trust the company to repay back all the debt.
That's right, because we mentioned it probably in the lesson number 2, the certification effect. When you have a private equity inside a company, it became easier for the company to raise money through debt. That's okay. But I would like to investigate more and to say why a private equity has to manage debt issuing. I don't want to say is hard or easy, because the answer is it's easy for a private equity investor to manage debt issuing because of the certification effect. But my question is, why, Stefano, a private equity investor that decided to invest in a company of Cindy, I have to help Cindy to raise money through debt? Because today I give a lot of money to Cindy. For what reason I have to help Cindy to raise other money through debt? For what reason? That's a question. Not it is hard or easy, because the answer is it's easy for me because of the certification effect. For what reason?
To multiply IRR?
Yeah, we have two reasons. The reason number one is I'm very hungry. The company of Cindy is quite good, but I want to multiply the IRR, and a very smart tool to multiply the IRR is debt. So I say, Cindy, today I gave to you 100 million euros, but don't worry, I arrange for you a bond issuing, and we raise other 500 million euros. Don't worry, I work for you. For what reason, you say, Stefano, I don't need other 500 million euros. Don't worry, I want to multiply the internal rate of return. We can use this money to buy other companies, to multiply your business, and at the end of the day, to multiply the value of your company. So this is the reason why I have to help the company to manage debt issuing. But there is also another reason, and the other reason is related to what we mentioned before, amount of shares. Because if we said the amount of money Cindy needs is 100 million euros, but 100 million euros represent the 90% of share, for me it's impossible to invest in the company of Cindy. Do you agree? A solution could be, Cindy, I give to you 50 million euros, which represent, I don't know, the 40% of your company. Don't worry, I help you to raise the other 50 million euros you need. So to manage debt issuing, in some cases, is a tool to multiply the internal rate of return. But in other cases, it's a natural consequence coming from the problem of amount of share. Because when the amount of share is very high, for the private equity investor, it's a nonsense to invest. A solution is we reduce our investment and we help the company to raise money through that. In order that the company has the amount of money the company needs, but I give to the company only an amount of equity which is okay with the amount of share I have in the portfolio. Okay? So two stories concerning the liability profile of the company. Targeting liability profile and what we have to set up. The last problem we have is rules of engagement, where rules of engagement means the rules for my stay in the company, the rules for my stay in the company. When we discuss about rules of engagement, I'm sorry, in this case, we have three different problems, three different topics we have to solve and we have to manage. The first problem is the problem of categories of shares. The second problem we have is the problem of paying policy. And the last problem is governance rules. So for the engagement, paying, we have three different problems we have to face. The first problem is categories of shares. The second problem is paying policy. And the third problem is governance rules. These are the three topics we have to solve, we have to manage to clarify the rules for my stay in the company, okay? If we get to this point, we solve a lot of problems, so the amount of money, syndication, loans, everything is okay. The last topic we have to manage is, now I stay in the company of Cindy, we have to fix some rules. The first problem is categories of shares, because the amount of share now is identified, okay? Because we identified the amount of shares in the topic number 1, targeting, and we manage the amount of share with the debt issuing. So now the amount of share, it's a set, but the problem we have is what category of shares? Because as you know, we can have common shares, but in the world, we can have also special shares. That means shares with special rights. For example, what is a shares with special rights?
Preferred shares.
Sorry? Preferred shares. Other example, convertible prefers, that means shares with embedded option inside. Typical of US, we have tracking stocks. You know tracking stocks, that means shares that give dividends, where dividends are related to some results of the company. So we can identify different categories of shares. It's quite hard, I don't want to say it's impossible, but it's quite hard that the private equity would like to have common shares. For what reason? Because we have to find a compromise between the amount of money, the amount of shares, and my rights inside the company. So typically, preferred shares, shares with embedded options are used in order that they can enhance, they can multiply my rights in the company, okay? Because typically, the private equity investor has not the majority. And because I don't have the majority, because I won't get the entrepreneur as the majority in the company, because the entrepreneur must have the right incentive, I have to protect myself. If I have the 30%, the 40%, the 20%, please remember, if you are not a majority shareholder, doesn't matter if you have the 30%, the 20%, or the 40%. You don't have any power in the company. Remember every day. Because you don't have any power, you have to protect yourself, and the typical tool is preferred stock, stocks with embedded options, special stocks that give to you some advantages and some special rights. Okay? Why a private equity investor is not generally a majority investor? The private equity investor only in one case is a majority investor, only in one case. In this time of the course, you have to know, guys. In vulture. Okay. Okay, but generally you can say in vulture financing, you don't have the entrepreneur. You understand? Because the company is not working. The company is not good, so you don't have the entrepreneur, with a difference between restructuring and distress, obviously, but you don't have the entrepreneur, and the private equity investor must become the majority shareholder. In the other clusters, seed, startup, early, all the other clusters, you have an entrepreneur, you understand? And in this case, the private equity investor strongly wants that the entrepreneur has the right incentive to go on. And the right incentive is the entrepreneur, you are the owner of the company. I'm simply an investor, you are the owner, this is your incentive. But if the private equity investor is not a majority shareholder, the private equity investor has to protect himself, because otherwise it's a drama. And the first tool you can use is categories of shares. The second problem you have to face, it's a bit tricky, it's paying policy. What does it mean, paying policy? Paying policy means simply, I have to pay a certain price for the shares I buy. I have to pay a certain price for the shares I buy. Very simple. We fix a price, we decided to buy a certain amount of shares, and I have to invest this amount of money. But in some cases, in many cases, we have a problem of paying policy. For what reason we have a problem of paying policy? In which sense we have a problem of paying policy? Paying policy means I have to give money to who? When you buy shares, not in private equity, in life, from a theoretical point of view, you can buy new shares or old shares, right? What's the difference?
You give capital to the company.
Yeah?
On the share, you give capital to the shareholders.
Okay, that's great, perfect. In private equity, coming back to the definition of private equity in lesson number 1, in every time, in every business, you have to buy new shares, obviously. But please remember, we don't stay simply in an handbook, we stay in the real world, and in many cases, you have to negotiate with the entrepreneur the mix of old shares and new shares. Because in many cases, the entrepreneur says, dear Stefano, it's okay that you enter in my company, I need your help, but I give to you an opportunity, and I want to have also some money. And the only solution I have is 90% of new shares, 10% of old shares, because I want to put some money in my pocket. That's relevant, especially for one kind of business. And the business is typically, you have to start to connect all the topics, because it's your problem in the exam. When we discuss about replacement, in replacement we have two businesses. What are the two businesses? Turnarounds? Okay. In turnaround, what's the problem? Turnaround is a corporate governance deal. In corporate governance deal, typically, the private equity will exit selling the shares to an existing shareholders, right? So in time zero, it's better that the private equity give money not only to the company, but also to the shareholders, because this money could be relevant in the future to repay again and to buy again the shares. So that's relevant in replacement that we design a mix between old shares and new shares, because otherwise the risk in replacement is that if you use only new shares, I give money to the company, that's great, but in this case, the company probably doesn't need money, the shareholder needs money. For what reason shareholder needs money? Because they need money because they have to buy again the shares in the future. So for the private equity, it's better not only to give money to the company, but especially to give money to the shareholders. So in every business, but mostly in replacement, you have a problem to identify the right mix of paying policy, where the right mix means the mix between old shares and new shares, because in new shares you give money to the company, and in old shares you give money to the shareholders. So it's a problem of paying policy you have to negotiate with the entrepreneur every time, every day. The last problem and the last topic is governance rule. It's the last topic, governance rules. What does it mean, governance rules? Governance rules means rules involving the board activity. Board activity. Governance rules means rules involving boarding activity. Give me an example of board activity you want to regulate by a special agreement with the shareholders. What you want to regulate if you are the private equity investor? What board activity you want to regulate? Did you study corporate governance in your life as a course? Did you study corporate governance topic? Obviously you say no, obviously. But don't worry. You stay in the company, what you want to regulate. Now everything is okay. We fix everything. I have the 40% of shares. These shares as an embedded option. Everything is okay. What I have to regulate now? Board activity, what I have to regulate.
If the company wants to change the board, it must have the permission from the PE investor.
Too complex, too complex, too complex. The first problem is very simple but dramatic. You have the first problem. The first problem is the scheduling of the meeting of the board. Remember, if you don't manage the scheduling, you can have the 40% of shares, you don't have anything in your hands. Because when you will discover the real world, you will discover that in many companies, which are small and medium enterprises, the number of meetings of the board of directors per year is 0. That's great. You have the 40% of shares, my compliments. But there are no meeting of the board. So it's the entrepreneur that takes all the decision. So your first problem you have to regulate is the scheduling of meeting, because otherwise you don't have any possibility to demonstrate your power inside the company. So this is the first activity you have to regulate, scheduling of the meeting. Second, the second problem you have to solve and you have to fix, you have to identify some veto rights on some topics. The second item you have to regulate is veto right or veto rights on some topics. That means the private equity investor has the 30%, the 40% of shares, but I would like to have a veto power on some topics. If the entrepreneurs tomorrow morning wants to launch an IPO, the entrepreneur cannot, because I have a veto right. And I have to say, I'm sorry, the entrepreneur, but I have a veto right, you cannot. So you have to identify some topics on which you can spend a veto right. The number 3 governance rules is related to the possibility that you have to nominate some managers inside the company. You want to have the right to nominate managers in the company. What kind of managers? It depends on the negotiation, the CFO, the CEO of the company. Every story is different, but even though you don't have the majority, you want to have the capability to nominate some key managers inside the company. Okay? Please remember, guys, if you don't have the majority and if you don't manage the scheduling of a board, if you don't have the possibility to nominate a manager, and if you don't have a veto right on some topic, you can have the 20%, the 40%, the 49%, your relevance in the company is equal to 0. Please remember. So you have to protect yourself fixing some governance rules. These are the 3 typical tools you have to use. We have a lot of other minor details. I don't want to be very boring. It will be, in my opinion, more useful for you to discuss about specific details in the second part of the course when we'll see some specific deals. Today I would like simply to highlight what are the most important topics you have to manage concerning the governance rules. Okay? And these 3 topics are the most important generally to fix governance rules. Okay? This is the story of techniques to finance the deal. Great. What we have to do? We have to discuss about managing and monitoring now. Managing and monitoring. Managing That's great. Managing and monitoring. Managing and monitoring is the activities or the group of activities you have to develop during your stay in the company to create and to protect the value of the company. So managing and monitoring means to fix, to identify rules and activities which enhance you to create and to protect the value of the company. Because during your stay in the company, you have 2 different problems. The problem number 1 is to try to multiply the value in the company. It's obvious. But the other problem you have is you have to protect the value the entrepreneur and you created in the company. Okay? So really two different activities you have to identify. In managing and monitoring, we have to highlight, to identify two different groups of activities. So take care about these two groups of activities because they are really the core of the private equity stay in the company. The first group of activities is related to the actions you can develop to create value. So actions means the activities the private equity investor really can develop in order to multiply the value in the company. So actions to create value. Take care, because it's not easy. Actions to create value are related, we can say, to the style of the private equity investor. We cannot regulate actions to create value. Actions to create value are really related to the style, to the strategy of my stay in the company. We cannot regulate it. On the other side, we have to fix rules to stay together to protect value. So from one side, we have to identify actions to create value. On the other side, we have to set, and in this case, they are rules we have to write together. We have to identify rules to stay together to protect value. So from one side is related to strategy and style. On the other side, we have to identify some specific rules we have to identify in order that, as private equities say, we can live in peace and love together for some years. Okay? As private equity really like to say, private equity stay is like a marriage, okay? But ex ante we know that there will be an end, okay? And to run a marriage, you need two different bodies of rules. From one side, you need a feeling, actions to create value. You cannot regulate the feeling, okay? Probably have a big expectation of a great feeling, but it depends, I don't know, from God, from luck, okay? Feelings. On the other side, it's better to write something, okay? Not for marriage, probably. But because it's a marriage with an end, it's better that we write a lot of stuff. For what reason we have to write a lot of stuff? Because we want to live in peace and in love for some years, and it's better to avoid conflicts ex ante. So the reason why we have to write rules to stay together is for avoiding conflicts during the marriage. So the first story is a story of feeling. The second story is a story of contracts to avoid conflicts in the marriage. Actions to create value. It's very difficult in a classroom to discuss about feelings, okay? Because the content I have to discuss with you is, okay, what a private equity can do to create value in a company where to create value it's a story of a feeling and the story of soft activity the private equity can do for the company. I would like to have your help. What a private equity can do to support the company to create value. In many lessons we discuss about the activity a private equity investor can do for the company. I would like really to write a list. What a private equity can do to create value for the company. Many activities we mentioned when we discuss about the clusters of private equity. Please help me to remember what I can do for you. What I can do for you.
To find suppliers.
Sorry?
To find suppliers.
Okay, management of suppliers. Okay, suppliers. Customers. That's quite strong. Management of suppliers, management of customers, or discovering new customers and new market, that's quite important, both for revenues and cost and working capital, okay? Why I can help you? Because I can give to you the access to my network, okay? That's useful to manage a relationship with suppliers, to discover very good suppliers, to discover new customers and new markets. That's perfect. What I can do for you?
I give you my reputation.
Okay, but I use my reputation to discover customers and suppliers, so something different. Another activity is arranging financing, okay? Other activities I can do for you. Recruiting people, you can need my advice to recruit people all around the world because of my reputation. For me, probably it's easier to recruit people for you if you need, so recruit people. Other activity I can do for you. To identify, to discover the best advisors for many activities. You need a legal advisor, you need a strategy, don't worry. I find it for you. Don't worry about that. So, looking for advisors, other activities, other two activities I have to mention. The other activity is mentoring. Mentoring is quite difficult to be defined. Mentoring means 24 hours per day, 7 days per week. Don't worry, you can give me a call. We can discuss together. I can advise you if you have problems, if you have troubles, like in a marriage, okay? 24 hours, sometimes it's difficult because I would like to sleep, but okay, 24 hours per day, okay? Mentoring, to advise you on what? I don't know. I stay at your disposal because we stay together. Mentoring activity. In many interviews with entrepreneurs, this activity is considering the most important activity a private equity investor can give to an entrepreneur. Mentoring. The entrepreneur must have the feeling that the private equity is ready to help him every day, every time. Mentoring activity is quite important in terms of psychological support from the entrepreneur. The last activity typically is called board services. Board. What does it mean, board services? Board services means many companies don't have the culture or the capability to manage a board and the corporate governance. Believe me, if you enter a small company or a medium companies, they don't have a board. They don't know what does it mean corporate governance. The number of meetings per year is 0. For what reason? Because there is an entrepreneur, simply that. So board service means to give support to the company to organize corporate governance, to organize board activity. It's quite important if in the future we have to sell the company to another company or we have to launch an IPO. If you don't have a board activity, it's impossible to launch an IPO. And typically this is a job which is given, which is developed from the private equity investor. Suppliers, customers, arranging financing, recruit people, looking for advisor, mentoring, board services, typically are the most important actions the private equity investor can develop for the company. I would like simply to give you two labels which are quite important. Every private equity investor has a different style to manage this activity, okay? Because it's a very complex mix of activity. So it's impossible to say you have to do this, this, and this. No, it's a mix, okay? In the language of private equity investor, we identify two labels to classify the mix of this activity. And the two labels are hands-on and hands-off approach, or hands-on and hands-off style. Typically, we say a private equity investor has or follows a hands-on approach when the private equity investor offers all these activities and give a very strong support to take industrial decision, hands-on approach. I give to you all these activities, I stay in your company, and I give to you a very strong support to take industrial decision. You cannot regulate it. It's related to my style, you understand? We use the label hands-off approach when the style of the private equity is not to stay in the company, but the style of the private equity is, I give to you the access to my network, I help you to find money, but I don't have time to advise you for other stuff. Hands-off approach. Take care, because actions to create value, it's a story of feeling. And we find entrepreneurs that would like to have a private equity investor that every day stay in the company with an hands-on approach, because you need a lot of support coming from me. But there are a lot of other entrepreneurs. They don't want the private equity in my house. I don't want you. You are my shareholders, I understand, but I am the entrepreneur, and I do prefer hands-off approach. So thank you very much for the network you give to me. Thank you very much if you're able to arrange financing, but that's it. I want to recruit people, advisor, I have my advisor, I don't need mentoring, I don't need board services because I'm very strong. Hands-on, hands-off approach are the two styles we find in the market, and in many cases, the companies select the private equity for a lot of reasons, but mostly for this reason, because I'm looking for an hands-on or a hands-off approach private equity investor. This is the story of actions to create value. On the other side, we have to write rules. That means I'm very happy that private equity investment is a story of feeling, but you have to write something. To write something where the goal, the topic is to avoid conflict. If we want to write something, it's quite interesting to find that in the market we find a lot of golden rules which are devoted to regulate the stay of the private equity investor in the company. So in the common language, in the practice of a private equity investor, we find a lot of golden rules we can use to regulate the stay of the private equity investor in the company. So the last topic we have to discuss today is the golden rules we can use to regulate the stay of the private equity investor in the company. Okay, is the last list of topics before the midterm exam, so you are very lucky, but you are unlucky because it's very long. So we have to identify 9 different topics. Okay, life is very complex, okay? Take care, because even though it's the last topic, it's quite relevant, because when you have to regulate your stay, your problem is, okay, there is a list of golden rules, you have to manage cherry picking between the different rules. Because I would like to mention golden rules. I decided to use the list of golden rules which is recommended by BVCA, British Venture Capital Association, because this list of golden rules is considered really the Bible for the private equity investor. So I do prefer to use a sort of official list of golden rules rather than to use my idea of golden rules or golden rules coming from an handbook. So I decided to use a list of golden rules used by the BVCA because it's really the Bible. So BVCA created a list of 9 golden rules we can use, and I used this list to discuss with you. So first of all, we have to highlight and to give the name to the 9 golden rules. Some of them are very simple, others are not very simple. So first of all, I write the label. The golden rule number 1 is lock up. The second rule is permitted transfer. The golden rule number 3 is staging technique. Golden rule number 4 is stock option. Probably they are not à la page today. Golden rule number 5 is shares with embedded option, where shares with embedded option sometimes are called callable and puttable shares. Okay? In the trivial language of practitioners, we do prefer to say callable and puttable shares. The rule number 6 is tag along right. Number 7, drag along right. Number 8, right of first refusal. And last, exit ratchet. Okay? These are the classical 9 golden rules you can use, you can identify, and you can insert in the agreement with the company. So lockup, permitted transfer, staging technique, stock option, shares with embedded option, callable or puttable shares, tag along right, drag along right, right of first refusal, and exit ratchet. Let's start from the number 1. Lockup is very simple. Lockup means the private equity investor has to stay in a company with a timing, with a minimum timing we fix ex ante. Lockup means that the private equity investor has to stay in the company for a minimum duration we have to fix ex ante. So the concept is, I invest in a company, but we sign the contract that I cannot exit from the company before 3 years. Later I'm free, but for 3 years I have to stay in a company. What's the meaning? The meaning is the entrepreneur is very weak. The entrepreneur is afraid to lose the support of the private equity, and the entrepreneur says, I'm okay that you invest in my company, but you have to write an agreement, and your engagement is for a minimum of 2, 3, 4 years. It's obvious that the lockup is typical of stages like seed, startup, early growth. I don't want to say it's impossible, but it's unusual to find lockup in expansion, replacement, vulture. Okay? It's more typical for seed and startup, where the entrepreneur would like to have the guarantee of the stay of the private equity investor for a certain time. Okay? Obviously, the time is completely free. It depends from a deal to another deal, but lockup means you have to stay for a certain time in the company. Permitted transfer, please.
One question for the lockup. Is it unusual to have, instead of a time interval or a decision, can they have like a performance bar? So maybe when we achieve so-and-so, you're allowed to exit, or when I achieve...
From a theoretical point of view, I have to say yes. But from an empirical point of view, lockup simply means we have to sign an agreement where we fix a minimum stay. And the minimum stay is not conditioned to some result, is not subject to. I don't want to say you are not right. From a theoretical point of view, it's perfect, but when we say lockup, typically is a fixed stay of the company. Permitted transfer. Permitted transfer means the private equity stay in a company because in most of cases I'm not a majority shareholder, The risk is that the other shareholders sell their shares, okay? I invest in the company of Cindy, I have the 40%, and tomorrow morning Cindy would like to sell the shares to other people. You understand that it's a problem for my marriage, okay? For this reason, permitted transfer means even though I'm not a majority shareholder, you cannot sell your shares without my approval. Permitted transfer. You cannot sell my shares without my approval. It's obvious that the permitted transfer is a sort of golden parachute for the private equity investor, so it's quite common, but every rules depends from negotiation. So if my reputation is lower than the reputation of the entrepreneur says, "Dear Stefano, I'm very sorry, I don't want to have a permitted transfer because my reputation is higher than your reputation, so I don't sign this agreement." But generally, because the reputation of the private equity investor is higher than the reputation of the company, in many cases we find permitted transfer.
I didn't get whether the entrepreneur cannot sell the shares of the private equity investor or the other existing shares.
Permitted transfer means the entrepreneurs, we have obviously to identify who is or who are the entrepreneurs. But let's say the entrepreneur, that means the majority shareholder. The rules is very simple. The majority shareholder cannot sell existing shares without the approval of the private equity. Simply that. Simply that. You want to sell the shares to your wife, you want to sell the shares to your son, you need my approval. It's a sort of veto right, okay? You cannot do that without my approval.
Even if I want to sell shares to all shareholders?
Sorry?
Even if I have to sell my shares to...
Yeah. But obviously, if a sort of veto right, if your idea is not complex, I say yes, you can do that. It's very simple.
Because I thought it was just to avoid the entering inside a company of other people that I don't know.
Yeah, but it's not the right perspective. Permitted transfer means we give a special power to the private equity. You want to use this power, you don't use, it depends from the many cases we will find in the world. I have this power, simply that, simply that. Rule number 3 is a staging technique. Guys, staging technique is very popular, especially in US and UK, is not quite common in Europe. So staging technique is a technique in which the investment of the private equity is given through different tranches. Staging technique means the investment of the private equity investor is not given in one solution, but is given through different tranches. That means, dear company, dear Cindy, I decided to invest 100 million euros in your company, but I don't give 100 million euros to you today. We identify different tranches of 20 millions, and I give this different amount subject to some specific results. That means staging technique is an incentive for the entrepreneur, but it's a quite powerful mechanism to monitor the company, because I give money to the company only if the company is able to get to some specific results. In terms of revenues, in terms of EBITDA, in terms of what you want.
What kind of earn-out option?
Not exactly. Staging technique means I decided to give to you this amount of money, but the whole amount is subject to some specific results. And we have to identify different portion of your investment, considering a timing, obviously, and considering some specific results you have to get to. Staging technique is quite popular in US and UK, and is typical especially of seed and startup, in which to monitor it's really, really fundamental. Stock option, probably you know, stock option is an incentive which is given not to shareholders but to the managers. Stock option is the option we give to the managers to buy shares of the company at a very lower and convenient price. Why a private equity investor needs to give stock option to the management, in your opinion? For what reason a private equity investor has to give stock options to the managers? Why is relevant? Why is relevant?
For the engagement.
Yeah, for the engagement, but give me some examples.
If they have some shares of the company, they are interested in great value also for the other shareholders.
Yeah, because I want that in the company we have a common interest to create value, and I have to give an incentive to the managers. In order that the managers work for me, that means the managers has the same goal of the private equity investor, to create value. That's quite important because in some cases the other shareholders have not the same goal. Let's imagine a family business. Existing shareholders probably want to become rich, but probably their goal is not to multiply the value of the company. Their goal is to multiply the reputation of the company, to multiply the sales of the company, to multiply the benefit for the family, but these goals are not the same of multiplying the value. For this reason, many private equity investors would like to give stock option to the management in order that the managers has the same incentive of the private equity, where the same incentive is that we have to create value for the company. Shares with embedded option or callable and putable securities. What does it mean, a callable security or callable shares? Callable securities means that the private equity has a call option to buy the shares of the other shareholders. The private equity has a call option to buy the shares of the other shareholders. Why it's interesting? It's interesting because if the private equity is confident to produce a lot of value, and the private equity is confident to sell the shares at a very high price, the private equity would like to have a call option to buy the share from the other shareholders, to have the 100% of shares, and to multiply the internal rate of return. Obviously, to have a call option on the other shares is quite hard, because you have to find an entrepreneur that would like to exit from the company. But it depends from the economic cycle. If we stay in bad times, it's quite strange, but if we stay in good times and you create an internet company, you are an entrepreneur, we stay in 2000, you create an internet company, and you say, wow, there is a private equity that works for me. If the private equity is able to sell the company at an incredible price, it's okay for me that the private equity has a call option, we sell the shares at a very high value to the private equity, and we take a great profit. So callable shares make sense when there is a huge, tremendous possibility of profit. On the other side, we have a putable shares, where the putable shares means the private equity has a put option, where put option means the private equity can sell the shares to the other shareholders. Putable shares are fundamental. They are called the golden parachute when the business is very risky and when we manage a turnaround deal in which our exit is the selling of the shares to the other shareholders. So these are the two cases in which we want to have a putable security. The two cases are the business, the deal is very risky, and if the business is very risky, the private equity say to an entrepreneur, the entrepreneur, I'm very happy to finance you, but I would like to have my exit, my golden parachute. The other case is, in turnaround, we have to sell the shares to the other shareholders, and obviously we want to have a putable security because this is our exit. okay? Is 10:15, so I have to stop. What I ask to you, I'm sorry for that, is just to read on the slides the other points 6, 7, 8, and 9, okay? Please do that, because it's a nonsense to say, okay, for the first midterm exam, we have to study till to the point number 5, and for the second, to the point number 6, to the point number 9. So, sorry for that. I think you can read the other topics. Just 2 minutes. Now we have to stop, but just 2 minutes for the midterm exam, okay? As you remember, for those of you who like to run the midterm exam is based on 5 questions, so we find 5 questions. The time you will have is 1 hour and 30 minutes, so it's a very long exam, because I do believe that it's possible to evaluate you only through a very long exam, so 1 hour, 30 minutes. In the 5 questions, you don't find multiple choice or other stuff, so they are open questions. Inside the questions, sometimes you can find also small exercises, where small exercises obviously are related to the 3 Excel files we discussed together. That means the Excel file for the financial need, the Excel file for the carried interest, and the Excel file for the comparison of fiscal advantage. Don't worry about that. I don't want to say that there are exercises, okay? You don't have exercises. But inside questions, there could be the usage of numbers. If we have to discuss about management fee, probably you have to apply it to an example or something similar. From tomorrow, when I will have the other lesson with the other colleague of the other classroom, I insert exam of the other years in order that you have examples of the questions. In my opinion, I know it's very important for you because of psychological support. Is unuseful because every year the exam is completely different, because it depends from the style, from the story, from the feeling and the reaction of the classroom. But I know that from a psychological point of view it is important for you, but obviously questions will be completely different. But however, I will insert exam of past years. Sorry, just 1 minute. After the midterm exam, we will start, I did remember, in the middle of April. In the middle of April, we will have 2 lessons. These 2 lessons will be devoted to a business case, as it's written in the syllabus, where the business case is quite useful to discuss about company valuation. Because company valuation is a fundamental tool we have to use to discuss about exiting, to discuss about deal making. So we will devote 2 sessions, 2 lessons to face and to manage a business case. Okay? The business case will be managed mostly by Alberto Dell'Acqua, which is the tutor, even though we will stay in the classroom. But however, we will spend 2 sessions to face this business case. Later, there will be the next teacher, which is Fabio Sattini. However, even though there will be another teacher with a special guest, I don't want to say that every session I will jump in the classroom, but however, I will stay in the classroom many times to check if everything is okay. Just to give you the roadmap for what will happen, as is written in the syllabus, after the midterm exam. But now you have to spend your energy for the midterm exam. Okay? And we'll see next week for the exam.